Let's talk about this so-called everything rally that's been happening, right? Pete says, everything's been going up. I mean, tech, materials, industrials, new all-time highs today. Semis, new record high. Value around all-time highs. Gold, highest level since September 3rd. Bitcoin, intraday, all-time high. All 11 S&P sectors positive on the year. 9 of them are up double digits. So does this continue to be a buy everything rally, or do we start to say, you know what, maybe enough is enough? We're getting a little ahead of ourselves.
No, I mean, I think everything is working for a reason. It's because the economy is stronger. If we learned one thing last week, we learned that the ISM services rebounded to all-time highs at 66.7. We've never seen that kind of number before. Why is that important? It's 67% of the U.S. economy is services. Why is that important? It's driven by the consumer, which is also very important to the economy. And so we're rooting for this. This is good news on the consumer front. And I'm not surprised as a result to see consumer confidence rebound for the first time in 4 months. We also are seeing on the manufacturing side a recovery as well in factory orders, durable goods, and that sort of thing. So October rebounded, Scott. We had a growth scare in the third quarter, no doubt about it. But October rebounded as Delta variant kind of subside. So we now have the supply chain issues that we have to worry about, and we have to worry about inflation and being stickier. I've been talking about stickier inflation for months now, and I'm wondering if the bond market is actually starting to tell us it's going to lead to demand destruction. But there's so much distortion in the bond market, so you have to take it with a grain of salt. So in the meantime, you've got good growth on the economy, and then you have good earnings, and you have low interest rates.
I'm wondering
so actually, that's kind of Goldilocks.
I'm wondering if the bond market is telling you it's more disinflation at this point than inflation. I mean, I literally was just looking as you were speaking, and you look at the 10-year at 142, and you're like, holy smokes! Like, what is going on with that? What is the message that is sending? And by the way, Steph, a lot of the hottest, if you will, indicators of inflation have started to cool somewhat dramatically, too. So maybe that story is starting to turn, and maybe that's one of the reasons why stocks in such a broad array of sectors continue to hit these highs, as I've said.
Well, I think it would be stagflation versus disinflation. I mean, you had a hot PPI number. I know it was in line today, but you had a hot PPI number up over 8% year over year. Unit labor costs also last week very, very high. So what about the wage numbers and the non-farm payroll numbers at 4.9%? You have real inflation out there, Scott. My worry point is this inflation going to drive demand lower? And that is what I wonder if that's what the bond market is telling us. I don't think it's stagflation, especially after you get an ISM services number like that, when you get consumer confidence numbers like that, when you get manufacturing and companies within manufacturing telling you how strong demand is. So we have to watch it. It absolutely is a watch point for now. But I think into the end of the year, seasonally, this is the time when you want to be long, and especially as earnings estimate revisions are going higher, which they are.